One headline out of Washington just rattled the entire U.S. gold market, a 39% tariff on imports from Switzerland, including gold bars. As traders scrambled, spreads exploded, but gold prices barely moved. Today, CEO Keith Weiner of Monetary Metals will explain the real story of what happened and why the spreads breaking in the gold market might matter more than prices.
So what happened last Thursday with tariffs and gold? For quite a while, the market has thought that gold and silver presumably were exempted from tariffs. There was a big scare right after Trump got into office, and then he clarified that precious metals would not be tariffed. But now there's a lot of, stress on the relationship between the US and Switzerland. One of Switzerland's big exports is gold bars that come to the US. And so somebody had asked the Customs and Border Control, I believe, for a ruling letter on whether or not gold would be exempted. And they wrote back and they said the large format bars, which are 100-ounce bars and kilo bars, would be in a category subject to tariffs, which coming from Switzerland would be 39%. So, gold at 3,000 something dollars an ounce, 40% tariff would be, $1,200. Nobody is going to import gold. I mean, nobody makes margins like that in gold. This is not a high value market item. So the threat of that, tariff sent the gold market, shall we say, to a tailspin on Thursday and Friday. So many times when there's big news, let's say the economy does well, the gold price can sometimes go down as people say, oh, we don't need a hedge. Let's go all into equities. And then sometimes something bad happens and they think, okay, that's it. Monetary stimulus is coming in response to this bad news, and therefore the gold price goes up. But that was not the case with this particular tariff thing. If you only looked at the price action, you didn't really see much to talk about. I mean, there was a range for the 2 days, Thursday and Friday, of less than 1.5%. I mean, you'd lose that in the noise if you zoom out a month or 6 months. But what moved instead was spread, not price. And so most of the gold analysts, and the reason why I wrote the article and the reason why I wanted to talk on this video, is most gold analysts are trying to analyze this from a price standpoint. And the price certainly didn't move, and then they're trying to come up with a conclusion of why the price inevitably has to move, inevitably higher, of course. And that's not the case. What happened is the spread moved. Now, at this point, I think the whole thing's over, but the shouting, because the White House clarified that they're going to issue another executive order saying that gold isn't going to be subject to tariffs after all, and then the whole scare's over. But in this case, it was spread that moved, and the spread that moved was something that Monetary Metals studies. We publish on our website for free. All the data is there. We update the graphs daily, and that is the basis. So the basis in a commodity is the difference between the futures price minus the spot price. And why is that important? There are a lot of basis traders, also called warehousemen, who carry the metal, and that is buy metal in the cash market and simultaneously, at the exact same instant, sell a futures contract. They're not betting on price. They're trying to pocket a spread because future minus spot is almost always positive. In fact, in gold, it should never be negative. It does occasionally happen, which is a sign of a broader malaise. We won't be talking about that today. But there's a profit to be had. Now, most of the time, there's the following fact I'm about to share, doesn't matter, but this particular time it does. The spot market is London, and the futures market is New York. So that is, you're buying metal in London, you're selling a future in New York. Now, most futures contracts are closed. They're purely financial transactions. It's either hedging, someone needs a futures contract to hedge a position they have somewhere else, or they're just betting on the gold price. And that's closed without settlement, but sometimes you have to settle. Now, settlement means, taking that bar that you own in London and delivering it to New York. Now, the London market uses 400-ounce bars. A contract in New York is 100 ounces. You can't take Gold is very soft. In theory, you could stick it on your chop saw. Everybody has a 10-inch chop saw in their garage. Most people do. You could just chop it, but of course, first of all, you'd spray a lot of valuable gold everywhere, which you don't want to do. And nobody would take that bar. It would not be marketable. You have to send that to a refiner, which is very often Switzerland. The big refiners, the big LBMA refiners are in Switzerland. And you convert that, you melt that 400-ounce bar down, and you recast it either as 4 100-ounce bars or 12 kilo bars. And then you export those to the United States. You can deliver into a futures contract a 100-ounce bar in New York or 3 kilo bars, which works out to be almost exactly 100 ounces. And so the trade is, buy it in London, send it via Switzerland, come into the United States, and that trade occurs all day long. The shipping cost is something like $1 an ounce. Just to put this in perspective, refining, if you're doing very large quantities, is basis points. And so, at this time, the basis is proportional to the interest rate. So right now, a normal basis would be 3.5%, 4%, maybe 4.5%, depending. There's some variables that move it around, plus or minus a little bit. And the basis for October, spiked to something like 11%, on Friday. So the whole thing went completely haywire because what happened is when people realized that importing that bar from Switzerland is going to be a problem, they just closed their positions. These carriers, these warehousemen who were long London, short New York, have to close the position. Now, how do you close that position? You sell London, that is, you sell physical metal, which is pushing the price of metal down a little bit, and then you're buying future, which is lifting the futures price up a little bit, and you widen that spread dramatically when all of that unwinding occurred at the same time. Now, a lot of the gold analysts thought, okay, that these are short sellers that are going to have to close, and that's going to drive, there's going to be a short squeeze and drive the price higher. Anybody who's short as a speculation isn't planning on delivering metal. It's just purely a play to trade. They don't have this issue. This is only for the arbitragers. So you get essentially no effect on price and a dramatic widening in spread, which means the market becomes screwier and less usable by mining companies and refiners and jewelers that have to use the market for hedging. It becomes less reliable, more expensive, to do business in. Your tracking instrument doesn't track as accurately, so there's all kinds of other little frictional costs those businesses have to eat, and that's exactly what happened. You threaten tariffs, and all of a sudden, boom, drive the market into a tailspin, and that's what happened last week. So an interesting question to look at is, how can it be that the internals of a market can be disrupted as I describe, and what's visible externally, there's no sign. The price didn't really move. To use an analogy in the human body, if someone gets, let's say, bone cancer, there isn't really anything you're going to see about that person externally. And there's rumors that there's certain animals that maybe can smell cancer. I don't know anything about that, but to a human observer, you don't really see anything. But what's happened internally is that the market has become less coordinated. So a key thing that I proved in my dissertation, which is on my personal website, by the way, anybody interested, it's on keithweinereconomics.com, is that every time the government interferes in a market, and regardless of the stated reason is always to offer some improved outcome to some group or another, what they always inevitably end up doing is reducing the ability of traders and producers to coordinate their actions in the economy or in the market. And this is a perfect case of that. So, this has made it harder, especially for U.S. businesses, who might have to import gold, obviously can get impacted by this. So we might see, if this continued, you might see the prices of gold products made from these bars, rising a bit internal to the U.S., but the world market, the price isn't really disrupted. And if you're only looking at price, that's like, standing, 10,000 feet, 2 miles away. You don't really see that much, but the closer you get and you start to see inside the windows of the building, you see that, yeah, there's a problem, going on there. So the question is, does this signal that, the Trump White House is regarding gold as different from other commodities or other metals by its use of the term specialty product, or are they just saying, no, it's the same as other commodities? I think the specialty product language comes from the original ruling, the letter ruling that said kilo bars and 100-ounce bars are like partially completed special. There was some language about specialty products. I don't remember what that was. So they're saying, okay, that's probably going to be exempt. So, okay, I've just said this is not really a price. Tariffs are not really a price issue, but a spread issue. But if I had a gun to my head, forced to predict, is supposing that the U.S. imposed a tariff and really meant it and it stuck on gold, would that reverse the bull market? No question, we're in a bull market in gold right now. Could that reverse it? In a certain sense, it makes gold less attractive as an asset to own, because when you buy it, you may be paying a bigger premium, which you may not recover when it's time to sell it. And so an asset with a wider bid offer spread becomes less attractive to own. That's true. But gold is kind of unique in that the more the government signals that it doesn't want you to own it, the more that a lot of people, I would say perversely, because it's kind of a perverse reverse psychology thing, except in this case, it's not actually perverse. It's correctly. The more people correctly think that, okay, the government doesn't want me to own this, and that confirms all my reasons for wanting to own it. And so, maybe it's a case of a movable object encounters irresistible force, tariffs making it less efficient to own, the government telling you don't own it makes you more want to own it. Which way those two things end up winning at the end of the day, I don't know. But it's also important to keep in mind that the majority of gold demand is certainly now in the last year and a half is not the U.S. or the West. It's the four Eastern worlds. It's the Arab world, the Turkish world, the Indian world, and the Chinese world. And I don't think, the leaders in those places pay very close attention to U.S. policy, of course. I don't think the rank and file people in those countries do. And so, would this affect the Turks' decision to buy a little bit more gold if they have an extra bit out of their paycheck? Probably not at all. So my guess would be that gold remains in a bull market, i.e. the dollar remains in a bear market as measured in gold. And I don't think that's going to change just because the U.S. basically says to the futures market, get out of, that's what would happen, is the futures market would have to leave the U.S. It would be impossible to operate a futures market where there's a 39% import tariff on the thing that you're trading in. And I don't know whether it would move to Canada, that's one possibility, whether London would want it, whether Dubai would win it, whether it would fragment a bit. I know a company that would want to try to pull it to Singapore. That is hard to say who would win, but the U.S. would lose. And, those banks and traders would have to move out of New York. And certainly the warehouses that are holding COMEX eligible bars would have to be somewhere else. Is this good for a monetary metals business? I think a lot of clients are going to want to know, does this make a monetary metals lease more attractive to the industry versus less attractive? Does it make them, let's say the jewelers less inclined to want to borrow dollars and then hedge it, let's say in the COMEX futures market, and therefore more inclined to take a lease from monetary metals? Thinking about that for a minute, and obviously it's far too soon to give any statistics about how much our business has grown or not grown as a result of this. But I would say any uncertainty and any distortions and waves in the futures market is bound to make users of that market, less happy, and bring to their attention that they're subject to risks. They were subject to these risks all along, but they hadn't really thought about it, right? So you borrowed, let's say you're a jeweler, you have $1 million worth of inventory, you borrow $1 million and you buy $1 million worth of gold inventory, you've got a risk. And the risk is that there's a mismatch between your liability, which is dollars, and your asset, which is gold. And if the gold price moves down, you are potentially bankrupt. So you say, okay, I'll hedge, and people use that word just. Sometimes just is a trigger word that means, well, it's a really big deal, but by using the word just, we'll minimize it and pretend it's not a big deal. So that means that you borrow $1.25 million, and you buy $1 million worth of gold, you put $250,000 in a margin account and short gold futures. Well, you flip the risk the other way. Now the risk, if the gold price rises, you're short gold futures and you make it a margin call. Now, if the futures market's going haywire and the spreads are much wider, it makes that market harder to use and certainly more expensive, but also it has more risks that perhaps have been hidden are now a little bit more obvious as they start to think about it. What are we doing here? And then if they come across monetary metals, like, maybe this makes more sense. So we'll see, what this does for the business, but that may very well be, a positive tailwind for us. So in conclusion, the dollar's in a bear market for reasons that should be obvious. The people that are managing it are increasingly we'll just say profligate. And if the dollar is going down against what? Well, most people try to measure the dollar against the other currencies, but the other currencies, even if they weren't being run by central planners that are equally or even more profligate, are dollar derivatives. So the whole irredeemable currency regime is like one big ship. We'll call it HMS Titanic. How do you measure the altitude of that ship? Well, you need terra firma. You need a rock against which to measure it, and that's gold. And so that entire fiat currency edifice is going down, and this isn't going to change anything. But what this tariff episode shows is that when the government wants to interfere, they're causing harm somewhere, and you may not see it in aggregate, macroeconomic aggregate such as GDP. You may not see it in the stock market. You may not see it in the unemployment number, but somebody is getting hurt, and somebody's getting dislocated, and somebody is finding it harder to make money, harder to survive in business. They're making less, and so these things aren't good. And in general, I would just say, let's have freer markets and less government intrusion. The flip side of that we offer gold leases to the trade is that we offer interest on gold to anybody who has gold. Open an account, get a yield on gold, currently 4%, monetary-metals.com, and thanks for watching.